Welcome to Real Vision Crypto, everybody. We've got a special show for you today. I'm joined by Alex Maschinsky, CEO and founder of Celsius Network, and Santiago Velez, co-founder and division lead of R&D at Block Digital Corporation, and of course, a frequent host right here on Real Vision Crypto. Today, we're going to be talking about earning and borrowing, yield generation, and the overall state of crypto markets. Gentlemen, welcome to you both.
Thanks for having us back.
Thanks, Ash.
So, Alex, let's start with you. I know you've been on Real Vision a number of times, but for people who aren't familiar with Celsius, tell us a little bit about your shop, what you guys do.
Sure. Celsius Network is a platform, membership platform, where we basically have 1.5 million users worldwide. We manage just over $20 billion. And our specialty is really in providing a yield for the crypto community. So we have 50 assets on the platform that pay yield, and any crypto user can basically transfer the assets to us. We hold them safe. We then lend them out, earn yield, and the vast majority of those rewards or the interest that is earned from the institutions and exchanges goes back to our community. We've paid over $1 billion worth of yield, and you can also take a margin loan or borrow some dollars against your assets, so you don't have to sell the assets and pay capital gains. And recently we also expanded into mining, as well as Celsius X, into different forms of DeFi.
So tell us a little bit about where the yield generation comes from. I know our viewers know that we've obviously been in a very low yield environment here in traditional capital markets. Tell us a little bit about how you guys generate yield.
So yield normally in crypto comes in two different ways. You have many protocols that pay yield, but really they do inflationary staking. So they will provide you rewards from their treasury, and they're just increasing the circulating supply. And as long as more people are joining the protocol than them adding tokens, prices stay stable or go up. Celsius focuses on a yield creation through actually lending of assets. So we support activities like market making, arbitrage, the equivalent to SEC lending in the crypto community. So we lend to institutions, exchanges, DeFi, CeFi, and so on. And all that creates actual payments from these institutions, which are then translated into yield inside our pools. So if you have 1% of the Bitcoin pool, our Bitcoin pool is about 135,000 Bitcoins, you will earn 1% of the payments made by these third parties to Celsius.
I should say, for people who are not familiar with traditional capital markets, SEC lending, securities lending is an incredibly sort of well-established business model. It happens all the time. This is how broker-dealers, in many cases, generate revenue. This is something that's a very well-established model. With that said, Alex, tell us a little bit about what some of the risks are inherent in your model and how you attempt to mitigate them.
Sure. So SEC lending is considered one of the safest business on Wall Street, but there is definitely counterparty risk. So if you use Celsius Network, you'll be relying on Celsius to select these counterparties or lend the assets to a safe counterparty that we know will pay back. And that's really the main risk. There is some risk on the transactions themselves, but we use MPC or multi-party computation technologies to whitelist and manage the keys with these counterparties in a very secure way. And again, in almost 5 years that Celsius have been operating, we have not had any instances where we are hacked or somebody stole any assets. So the main risk I would say today is are these counterparties savvy? Do they provide enough collateral? Do they plan to use it in a responsible way? And can they financially return these assets? And the industry usually goes once or twice a year. It goes through a flash crash, which we call a stress test. So in those environments, like we just had in January, 50% drawdown. In May, we had a 60% drawdown, May 2021, and another one in March of 2020 that was also 60% drawdown. That really tests the system. So if somebody has excess leverage or is not a worthy counterparty, usually those companies will go out of business or will have problems during these drawdowns. And again, happy to report that in all the last 3 drawdowns, Celsius did not have any default of any counterparty that we lent asset to. They had margin calls, but they all paid both the interest and the principal back. So we're in great shape, and that just proves the quality of the counterparties that we elect to lend to.
Yeah, I should say, just a note on the filming, we're filming here on January 31st, 2022. Obviously, we're in a steep sell-off right now. Bitcoin trading at around 38,000 as we film this conversation. That's off a 52-week high, basically a hair's breadth below 69,000 in November of 2021. So we're off, call it about 45% as we have this conversation. We're filming about 2 weeks before this is going to air on Valentine's Day, February 14th. So just a little bit of context here on where markets are and a bit about when this show will air. With that said, I'd love to pull in Santiago Velez to talk a little bit about some of your thoughts. Jump in, Santiago.
Sure. Thank you for having me. And I'm pretty excited to speak with Alex. I've been a longtime follower of the platform, so I appreciate the opportunity. Alex, one of the things in what you just said struck me as interesting. When evaluating your counterparties, you look at either a traditional financial institution who may or may not be involved in digital assets, but you also lend to DeFi protocols, DAOs, or organizations that do similar manner as a traditional institution, but just in a decentralized manner. How do you assess counterparty risk with respect to DeFi or DAOs? And does that weigh into maybe the allocation more so in traditional FI versus a DeFi? What are your thoughts on that?
Yeah, so that's a great, let me explain maybe more detail all the elements, because I agree with you. I think there's a lot of confusion about how this stuff works. So normally, let's say you bought coins on Bitfinex or on Coinbase, and you leave them there. These institutions, in most cases, are allowed to use that for liquidity purposes and other purposes. All Celsius does is when you transfer your assets, for example, from Bitfinex or from Binance, is that you allow us to negotiate on your behalf and on everybody's behalf, everybody in the pool, a fee for something that these exchanges used to get for free, right? So same thing with institutions, right? Normally institutions get access to these assets through exchanges. Here, Celsius demands a much higher fee than traditional markets, and DeFi is the same story. So Celsius provides liquidity on DeFi platforms. Sometimes we're a borrower when rates are low. Sometimes we get paid to take a loan. There are many instances in which loans are negative on DeFi protocols because these platforms either subsidize or provide token rewards to allow you to farm and earn yield. And Celsius would borrow billions of dollars on such platforms, providing collateral, right? So we usually post collateral and then borrow what we need, a stable coin or something else. Or we will be a lender, right? So when the rates are high, when there's a shortage of, let's say, Ethereum, or shortage of wrapped Bitcoin or any of these assets, Celsius would post those just to earn the yield, which is usually paid in kind. So we operate on both sides of the trade, and our job is to, because our community is a long-term hodler, we basically exchange the willingness of our community to take the risk associated with staying long with the fact that institutions are willing to pay to offset that risk. So when we choose these protocols, to your question, to answer more specifically, we do our own audit. We have 35 people in our security, on our SOC department, and they basically go and audit each one of these DeFi protocols. We vet dozens of these every year, and I would tell you that 90% of them don't pass our security tests. And usually we would contact these protocols and give them a list of the reasons why they did not pass. So we don't just say, sorry, not investing in your protocol. We'll give them, here are the 15 vulnerabilities that we found. Go fix those, and after that, we can consider you again. And smaller projects probably just don't have time to do it. Larger projects, go ahead and fix these things. But in total, we have less than 15 protocols that we deploy on currently. So it's a very, very select group that includes reliable things like Aave and Compound, as well as some newer ones. But it's a very, we have a very high standard for deploying on these protocols. And just to give one example, on the DeFi side, we are taking substantially more risk than lending on exchanges, centralized exchanges, or on institutions. And as some of the viewers probably saw, there was a hack on Badger. It was not a hack on Celsius, but Badger itself, the protocol, the smart contract, and access to the smart contract got compromised. And we selected Badger because their balance sheet or their DAO had close to $200 million in assets. So even though Celsius itself got damaged, the DAO decided to basically make everybody whole over time. And here, even though there was a break in the protocol, we managed to recover, or we will recover all of the assets over the next 2 years.
So Alex, just so for people who may not really have a sense of how DeFi works, these audits that you're talking about aren't sort of traditional underwriting standards that you'd be looking at to assess the creditworthiness of a counterparty. These are more tech audits that you guys are doing to assess whether there are critical vulnerabilities in the smart contracts themselves.
That's correct. So these are two separate things. One is the business model viable? Is the DAO providing a real utility, a real value both to the borrowers and the lenders? Or is it just some kind of a scheme or a hack that is not sustainable? So we don't participate in anything that is just inflationary yield. Plenty of other people love that, and they put their coins there, and good luck to all of them. So for us, again, like Aave is a borrowing and lending platform. It has very clear and precise rules. And Celsius is one of the approved platform, both on Aave and Aave Arc. And again, sometimes we're a borrower, sometimes we're a lender. We audited the Aave smart contracts, and we worked very closely with them to launch, for example, Aave Arc. And so all those things are requiring tremendous amount of work. And if you do it yourself, you can go and do DeFi yourself, but then you have to rely on your own knowledge and capabilities, or you can use a platform like Celsius where you're effectively letting us deploy across all these different strategies, select the platforms, and you still get to keep most of the rewards. And Celsius on average has paid higher rates than any specific DAO over the last 4 years.
Hey, if you like this clip, be sure to check out the full interview and more only on realvision.com/crypto. It's 100% free. Sign up now.